Welcome back to Fintech Layer Cake, where we uncover secret recipes and practical insights from fintech leaders and experts. I'm your host, Reggie Young, Senior Product Lawyer at Lithic. On today's episode, I chat with American banker reporter Polo Rocha, who covers consumer finance and national banking trends. We cover what's happening in the current bank earnings season, the state of regional banks 1 year out from SVB, and much more. While we focus on earnings from public banks, it generally applies to fintech sponsor banks. We covered this a little bit in the episode, but a lot of fintech sponsor banks aren't public since you can't easily get summaries of their earnings. So these are kind of general lessons and general trend observations that Polo's seen in the state of community and regional banks, which includes, the subset that sponsor fintech programs. So it's useful context for anybody thinking about what the current state of fintech sponsor banks' health is and what the year ahead looks like. And I actually thought his summary of the key headwinds that banks are facing in 2024 was particularly useful, and I plan to watch those items quite closely for the rest of the year. Fintech Layer Cake is powered by the card issuing platform Lithic. We provide payments infrastructure that enables companies to offer their own card programs. Nothing in this podcast should be construed as legal or financial advice. Polo, welcome to the Fintech Layer Cake podcast. Super excited to have you today and for our conversation, in part because of a ton of respect for American Banker. Excellent outlet. Like pretty much every lawyer in financial services I know, or fintech that I know, reads it regularly, including myself. So if folks aren't familiar, you should go bookmark American Banker like I do. But also before that, you worked at the prestigious Badger Herald many years ago in Madison, Wisconsin, which is actually where we first met. And funny backstory is we both worked at this college newspaper alongside each other, and neither of us had any financial services interest whatsoever at the time. And fast forward, and lo and behold, here we are. And I realized a few years ago, I was reading American Banker pieces with Polo's byline. So super excited to get you on the podcast because I know you have a ton of knowledge and are pretty deep on a lot of the stuff that's happening in banking, the state of banks and health and whatnot. So welcome to the podcast.
Yeah, no, thank you for having me. It's been fun to reconnect all these years later and talk about banks and fintech.
Yep. Well, cool. So first, we're going to kind of cover two big topics today, bank earnings and then the general state of regional banks a year out from SVB. We're recording this, I believe it's April 24th. So in case listeners want some timing context, we are in the middle of bank earnings right now, which is an area that Polo focuses a bit on. So would love to start out just by helping educate a lawyer like myself on what do you even look for in bank earnings? What are some of the key metrics you look to?
Yeah, usually it really depends on what part of the cycle we're in. I think right now when we open up a bank earnings report, we look very closely at their net interest income. And so that's the difference between what a bank makes an interest on its loans and what it pays in interest to its depositors. High interest rates have definitely let banks charge more on their loans, but they've also had to pay more to their depositors. So that difference, that net interest income right now is a big metric that I think investors are looking at. And then just broadly, I think there's kind of been concerns here and there about the health of banks' borrowers and how well their borrowers are keeping up on their loan payments. So I think there's some metrics like delinquency rates on loans, charge-off rates, problem loans. Banks kind of disclose a series of metrics that lay out how challenged are bank borrowers. Right now, the economy is fine, but I think there's worries about that turning at some point. So when we look at earnings reports, really, it's at this point in the cycle, it's net interest income and credit quality. There's many ways to measure that, but certainly will vary at each bank.
Got it. And for those kind of two key areas of focus, are there any particular trends or red flags or good things that you're seeing in the earnings calls right now?
Yeah, I think right now the trend you're seeing across the banking industry is a decline in profitability. Banks are having to pay more in deposits, and that's costing them. They have to pay interest to their depositors more and more. And so that's really crimping how much money they can make overall. It's worth keeping in mind that the industry is still pretty profitable. Don't want to overstate the kind of declining profitability, but some banks are having to pay more than others. And so some banks are having some bigger kind of profitability pressures. Even the big banks, JP Morgan Chase, biggest bank in the country, they kind of reported some somewhat disappointing news on net interest income and investors. Their stock went down 6%, which is for the country's biggest bank. It's a pretty big amount. So I think that's definitely one of the trends we're seeing. Regional banks seeing more pressure there in some ways. The other trend we're seeing is on the credit quality front, we are seeing things start to get marginally worse. We're seeing credit card customers start to fall behind on their credit card bills more than they have. It's not at levels by any means, but certainly worse than where it could be. And then some business customers are also falling behind on their loans. And some of those commercial real estate properties that have been much worried about among investors, I think the outcome there will be more nuanced than some investors worry, but we are starting to see those kind of one-off property in trouble and cannot pay back the bank type of situations.
Yeah, I know that's been a huge headline in San Francisco the past few months. What's happened with all the commercial real estate out there, which I want to circle back to a little bit later in the episode. Yeah, and I've also been hearing just like auto lending is getting like absolutely wrecked, which is that's a whole like behaves differently, has different characteristics than a lot of credit card loans, but also an interesting bellwether. One quick note for listeners, because I think this is interesting, is Polo's talking about a lot of the earnings that we can see from public banks, but actually Polo and I try to chat about this, and I think it's interesting. Actually, a lot of the fintech sponsor banks are not public. And so like these earnings, you can't necessarily directly see, but you can get a sense of how a lot of fintech sponsor banks that are more like community or regional banks, how well their health is by looking at general industry trends. So just want to give that context.
Yeah, and to that point, while they certainly do some novel activities and kind of working with fintech companies in ways that are kind of beyond your traditional community bank model, these banks are still out in their community. They have to get money from their community. Yep. And so that means that, if Chase is paying customers 4.5% on a certificate of deposit, that community bank is going to have to compete with Chase unless Chase isn't in their community. Maybe it's a rural area that Chase might not be at, or Bank of America or Wells Fargo. So yeah, certainly there's new activities that these kind of more fintech friendly banks are engaged in, but they're still banks. And I think they're still subject to some of those same pressures, particularly on the deposit front.
Yeah, it's interesting. We think a lot in fintech. We talk about like, banks just need to staff up, especially in the current fintech market where there's a bunch of consent orders. Like, banks just need to staff up, add people. But the reality is they have like an entire army working on like their normal business. And so they have like a bunch of headcount. And sometimes those people are doing both the like local loans to small businesses and also fintech partnerships. And it's a whole operational employee consideration that isn't often talked about. Are there any, besides interest income and kind of the state of credit, are there any other trends you're seeing in bank earnings so far?
Well, I think one kind of positive thing for banks right now is that capital markets activity is back. I think even at these high interest rates, they're starting to look at merging with other companies again. And, yes, interest rates are high. So issuing debt right now is not necessarily cheap, but I think companies have realized that maybe interest rates are going to stay where they are. So let's just borrow now or refinance loans that are coming due. And what that means for banks is banks are the ones that kind of put all these deals together, kind of do the underwriting on corporate debt and whatnot. So I think as it relates to kind of the pressures that banks are seeing on profitability and like interest income, this has been a line of, non-interest income, fee income. The bank fees are starting to do a little bit better thanks to this kind of return of the more Wall Street business, or even the more regional method of that kind of Wall Street financing, right? And kind of regional banks maybe offering those same debt underwriting services to a smaller corporate borrower that doesn't really turn to the bond market for stuff. So that's all starting to come back for banks after a dearth of activity. So that's been good for their profitability.
Yeah. Makes sense. Interesting to see, and it'll be interesting to see how it keeps playing out. Looking more prospectively, looking ahead, what are some of the biggest obstacles you think that these banks are facing for the rest of 2024?
I think the challenge about commercial real estate, which regional banks have more exposure to, it's a slow-moving picture, right? A lot of the worries about office leases, maybe apartment buildings in areas that have maybe too many apartments after a lot of building happened. But those kind of leases run out every few years or so. So I think that's going to be a more gradual story. And to the extent that we do see stress, it will play out over time. I think right now, really, the regulatory hurdles are pretty significant for the banking industry, particularly the regional and big banks. The Fed is kind of coming down with some new rules that may end up being softened after a lot of industry pushback, but are still tougher on banks than the banks kind of saw during the Trump administration. So the regulatory kind of picture is certainly an obstacle. And just kind of behind the scenes, there's just a lot of activity, and the supervisors at regulators, much like they're going into these fintech-friendly banks and asking questions about, is your business kind of performing on all levels, compliance-wise, whatever. Big and regional banks, I think, are kind of starting to see, or have been seeing, more supervisory questions on just a range of things. So I think that continues to be a challenge. And then just high interest rates. I think high interest rates have kind of been, at least at this level, been not so great for banks. And it doesn't look like the Fed is cutting rates as soon as markets hoped. So that's just going to continue to be a challenge for our much longer rates stay at these levels.
Yeah, interesting. I think there's in the fintech news arena, there's always there has been a lot of coverage of limits on overdraft fees that CFPB has proposed, and that's going to potentially reduce banks' revenue and viability a little bit, maybe. But you're right. They're all your first comment. There's a lot of other rules that, like, from a fintech perspective, I may not think of. There's a lot of Community Reinvestment Act proposals and like the merger guidelines that are actively being worked on that definitely have big implications for a lot of fintech bank sponsors. I mean, obviously, all banks of all sizes, community and regional. Yeah, fascinating stuff. Would love to switch over now to more like the state of regional banks, given that we're recording this a little over a year after the Silicon Valley Bank collapse happened, and obviously some other bank failures and collapses that happened following that. 1 year out from that event, where do things stand?
Big picture is the industry stabilized a couple months after Silicon Valley Bank. When you look at the big kind of worries that emerged in the weeks after about regional banks as a whole, I think the worst case scenario did not necessarily play out. Yes, First Republic, which was in trouble right away, would soon fail and be bought by JP Morgan Chase. But there's been some pressure with New York Community Bank, which is its own kind of case of over concentration in New York rent-regulated apartment buildings. But, and certainly the regional banks have had these profitability pressures that we talked about as they needed more funding post SVB. Maybe some dialed up how much they paid on interest to depositors, and the deposit picture certainly got more competitive with interest rates where they are. Certainly, those kind of continue to be pressures. And there are these worries, like I talked about commercial real estate, particularly some of the regional banks that have overly large concentrations. It remains to be seen. But I think even though things stabilize, I think there's still investor worry, and any sign of bad news from a bank can become really bad news. And that's what happened with New York Community Bank. Their stock went dangerously close to zero, and they had to get a capital infusion for Steve Mnuchin and company. So any kind of inkling of bad news drives a significant market reaction. And so I don't know if we're fully out of the woods yet. And I think that's what is driving some investors' concerns.
Yeah, it's been interesting to watch that negative feedback loop happen around certain banks. Definitely makes me appreciate the kind of psychological role that the FDIC and banking regulators generally play, right, in instilling confidence and whatnot.
Yeah, no, totally. And I think as it relates to the feedback loop, right, I think there's kind of a distinction between headline grabbing stock declines, headlines, including ours, that maybe we'll say the stock went into turmoil. Obviously, that's bad news for the bank's shareholders who are seeing their investment decline, and maybe new investment needs to come in to fix the bank, and that makes your investment even less valuable. But ultimately, what matters for a bank and whether it stays alive or not is also its depositors and whether they panic. And what happened with Silicon Valley Bank was most of its depositors were not covered by FDIC insurance, and so they had an incentive to pull their money out as soon as things got bad. I just don't know that depositors, frankly, read the news about their bank's health all that much. I think there's kind of this interesting tension between, and I guess it's good that, a bank stock can suffer, but, as long as depositors are mostly sticking around, it's really, I don't want to say that big of a deal, but it's certainly not as catastrophic as it could be.
No, definitely. It makes me think of, I think it's Daniel Kahneman, maybe Amos Tversky's, one of their quotes about summarizing behavioral psychology of things are not as important as you think they are while you're thinking about them. And I think fintech financial services spends a lot of time thinking about, oh my God, the health of these banks. But to our prior point, like these banks have normal businesses with local depositors that don't read these sorts of headlines at all and aren't keyed into this stuff.
Yeah. And the banks did I think it's fair to say, like, our Silicon Valley Bank and its peers were a lot shakier than your average regional bank. And yes, I think there's some long-term questions about regional banks being able to compete with big banks in terms of technology investments. And that's what's driving this kind of decades-long trend in consolidation bank industry. But these are ultimately, certainly some have more trouble than others. And the commercial real estate portfolios may be more of a mess at one bank than another. But broadly speaking, these banks are built on a much shakier foundation. And they have to be because, regulators are supposed to kind of go in there and make sure that they're not getting out over their skis in any one way.
Yeah. Speaking of regulators, I'd love to hear what you think some of the biggest lessons and takeaways from the 2023 bank collapses for. And that can be from a regulator's perspective or just in general. What are some of the lessons we've learned?
Well, I think one big one is really the stability of depositors and a renewed focus on having high levels of uninsured deposits is certainly bad news and certainly can drive what one might have thought were previously sticky customers. Turns out that they might not be so sticky when there's a lot of money at stake. I think another big lesson is interest rate risk and a bank's vulnerabilities if interest rates rise. Interest rates have been or had been pretty low for 20 or so years, maybe, or probably less. Really, after the financial crisis, the Fed cut rates to basically zero and only lifted it soon after.
It's so funny to me how people complain about how interest rates and mortgage rates are so high. And it's yes, they're high relative to what they were 3 years ago, but they're still below historical averages. It's just mind blowing to think about how much our public psyche is rooted to the 0% interest rate.
Yeah, totally. Banks are run by people who maybe did not have extensive experience when interest rates were at those levels. And I think we all have our own biases, and maybe some of that was at play here. I think with Silicon Valley Bank, they just bought a bunch of long-term bonds that basically flopped when interest rates rose and eroded their value. That was all kind of out there in public. But I think when depositors realized it after Silicon Valley Bank announced, oops, we have to rearrange our balance sheet, that's kind of what sparked the panic. And it all goes back to a small amount of banks took on, I think, far more risk than they should have on the interest rate side. And it's a really basic banking 101 part of risk management, but it was forgotten about for a long time. The 2008 crisis was really not about interest rate risk. It was about credit risk and the complexity of the financial system with all these complex instruments built on mortgages that maybe were somewhat rocky. That was a credit crisis, right? And we've kind of designed a bunch of rules to guard against that type of scenario. And the big banks have a lot more capital. Regional banks have a lot more capital. But there's still this kind of very basic interest rate risk. Goes back to the early days of banking. And I think there are some mistakes there. And then there are some of the mechanical issues that we saw in terms of banks. Some of them are, I guess, not as plugged in as to in the mechanical way of getting the emergency funding from the Fed that they might need, the Fed discount window. I think there's some mechanical issues that I think regulators are working out just to make sure that A, do those bells and whistles work? And B, can banks actually tap them? Because once you tap them, you're in trouble, right? So I think there's some questions about stigma and some more mechanical questions about ability to access these funding sources that I think we're still working out.
Yeah, those emergency funding sources are so funny to me because it's I remember this happening in COVID. The Fed set up some emergency lines of credit, and it was really about signaling to the market that they were willing to invest and provide these lines of credit to financial institutions in need. It didn't matter that these FIs barely use them at all. It was just signaling we're here to backstop and be a support. So, super interesting aspects of banking.
Yeah, totally. I mean, this is why, the Fed was set up all these many years ago, is to provide good banks emergency funding to kind of get them through crunches. And whether Silicon Valley Bank and others were good banks, certainly they had kind of good assets, just very kind of underwater assets. So, these are kind of critical to our financial system, these tools, to make sure that, whenever there is kind of panic, because that's just a natural part of economic cycles, it seems, we have the tools in place and, the ability for folks to use them to get through the crunch and, make it through the next day or month.
Definitely. Well, Polo, this has been awesome. I appreciate you coming on and giving me and our listeners an overview of bank earnings, what we're seeing and how they work, and the kind of state of banking you're out from Silicon Valley Bank. So if folks want to read your wonderful reporting or get in touch with you, where should they go?
Yeah, you guys can just go to AmericanBanker.com. We've got a strong team that covers regulation, banking, like me, fintech, and these policy questions that kind of are at the heart of the intersection of all that. Or you can find me on LinkedIn at Polo Rocha, and happy to be in touch.
Awesome. Thanks so much for coming on the podcast.
Thank you. This is a lot of fun.